Welcome back to the channel, traders. So today we are going to be looking at another important concept in Forex trading, which is liquidity. So you will be wondering why you enter into the market, you want to buy, and you have your stop loss. Say you enter into the market, you want to buy from here and then to the upside, and you have your stop loss around here, and you see the market do something like this, take you out and go your way, and you are surprised. I got the direction, but why did market take me out? It is because you do not understand the concept of liquidity. If you understand the concept of liquidity, you will not be taken out by the market. And you'll be wondering why you are selling and then market takes you out and starts selling towards your direction. You need to understand what liquidity means. Okay, so stay with me as we go together in this lesson. If you are just new to this channel, do well to hit the subscribe button and also turn on the notification bell so that you can be notified when I drop my videos from week to week. And make sure you click the like button. It's an encouragement to me. Thank you. So at the end of this teaching, it is expected for you to have an understanding of what liquidity really is, and also understand what the big banks do, how they use liquidity to trap the retail traders, and then also have a proper understanding of how to utilize the knowledge of liquidity to maximize profit in the market. So these are the things I expect you at the end of this video to understand. The first thing we'll be looking into is what is liquidity. Now, if you have a car, you will agree with me that you cannot move your car without a fuel. Yes, you cannot move your car without a fuel. I'm not talking about the electric cars and the cars that make use of gas and all of that. Even the car that makes use of gas or electricity, electric, they move by the reason of that thing. So what makes the market to move is liquidity. What moves the market? So we say it's like the fuel of the market, is the reason why the market is moving. That's why the retail traders do not have the ability to move the market. It is the big banks that move the market. Now, what is liquidity? Liquidity is just money, a pool of money, where money is packed. Let's say this is a pool of money. Let me say we have 50 billion sitting right here. 50 billion naira sitting right here. So this is a pool of money. It is because of this money that is here that markets will move towards this direction. So it is the motivation, it is the reason why market moves. So it is a pool of money. That's just the point. Liquidity is a pool of money, and there are places where liquidity are found. If you have an understanding of where this liquidity are packed, you will now know when you see one. Liquidity are orders. You see the way I buy? I place a buy here. Where I'm placing a buy, for this market to go in my direction, it means there is somebody that is selling to me. And if I'm selling from this point, it means that there is somebody that is ready to buy it from me. So buy orders, sell orders, sell stops orders, buy stop orders. All of those things are liquidity. Let me write them. Sell orders, sell order, buy order, buy order, stop loss, buy stop, sell stop, sell stop. All these are all these are liquidity. They are liquidity in price. Okay, so the way you can identify your liquidity on your chart are where you find your lows and your highs, your support and your resistance. These are like, you see the market going this way, making series of higher highs, higher lows, and doing things like this, making series of lower highs, lower lows. Yes, I talked about all of this move in the market in my previous video on market structure. You can do well to check it. I'm going to drop the link in the description below this video, so you can do well to click on the link and watch the video to understand what market structure is. Now, this, on all of these points here, at this point here, we have, this is a low, this is a high. Liquidity is packed here. Here, at this point, you find liquidity packed here. So this is a pool of liquidity, because the reason is because, let's say someone is interested in buying this trade. We have this is a high. Now this is a break of structure. You have this break of structure. I've also created a video on break of structure. You can search for it and tap into that knowledge. Now you have a break of structure. One having the knowledge of market structure and all of that would want to buy around here. Maybe you have your order block here, your demand zone, your fair value gap, whatever point of interest you use in trading, depending on your trading style. Yes, so you see a trader wants to buy from this point here, and what will he be doing? You put a stop loss here and target this high. Put a stop loss there and target this high. Now, these market makers have an understanding that traders would want to put their stop loss below the lows. They want to put their stop loss below the lows. Now, what would they now do? They will move this price and sweep this stop loss, then move the price higher. You see that? So instead of this price normally moving from this point higher, now the price will come and sweep this low, sweep it this way and move impulsively to the upside. So this is because they know that there are many stop losses that are here, and these stop losses are liquidity. They are liquidity. Now, mind you, as they are breaking this low, they are coming for a zone. Maybe we have a fair value gap here, or another demand zone here. So they will use this one as what? As a liquidity in price to push price higher. But mind you, this is a low. Here is a low, is a higher low. So what I'm trying to explain is that you find liquidity in your higher low, your higher highs, and your lows. Now, for those that trade, the same thing happens in a downtrend. Okay, the same thing happens in a downtrend. For those that trade support and resistance, you see market moving from support to resistance, from resistance back to support, from support to resistance, and all of that. Now, some traders knows that this is a support zone, a resistance zone rather. That's a resistance zone, and this happens to be your support. They would want to start buying from this support zone, start buying, from the knowledge of support and resistance. After the first, second, and the third touch, buy from the third touch. So they would want to be buying from the third touch and have their take profit here. Now look at what price we do. Price knows that they are going to be targeting to buy from this point. It will sweep this liquidity this way. It will sweep that liquidity, so that those that have their stop loss below this point will be what? Their stop loss will be taken out. Now, it is not just those that have their stop loss here that will be taken out. There are other traders that are breakout traders. They are breakout traders. They are waiting for price to just break out. And the moment price break out, they are waiting for it to what? To retest. Break and retest. So they would want to start selling. So these breakout traders will start what? Will start selling from this point. Oh, market has broke out from the support. Support has turned resistance. Now let's put our stop loss here. So now the people that are buying have their stop loss triggered. They have lost the trade. Those that are now trying to sell in the direction of the market have their stop loss at this point also taken. So both buyers and sellers are out of the market. Now the big banks are enjoying their profit and taking the price in the direction of the market. So this is what these big banks do to traders to ensure that they have a lot of liquidity to move the market. So you find liquidity. You find liquidity in all of these zones. Eyes on the lows, on support and resistance levels, and also you find it on the trend line. I took a trade today and I'm going to show you why I held that trade, even though it was very slow, but I had to hold that trade because I have the knowledge of this liquidity. Now, this is a trend line. This is a trend line. We call it trend line liquidity. Trend line liquidity. So you see another one up here. So there are people that have the knowledge of trend line trading. Those support and resistance, they also trade the trend line. So after the first bounce, the second bounce, the third bounce, they want to buy from here. They want to buy from here and target this high and target the next trend line zone. Yes, you treat it as a zone. So their stop loss will be here. Now, what will the market do? What will the market do? You see the market do this. See the market pick up their stop loss, trigger their stop loss, and go in the direction of the market. So, and that is why those that understand the concept of trading this trend line, they wait for sweep of liquidity. After that sweep of liquidity, that is where they want to start engaging their price. So they have different confirmations that they use, the candlestick confirmation, then they wait for the sweep of liquidity before engaging the price. So by the time we get to the point where I will show you how you engage it and then go to real life chart examples, you will get a proper understanding of how to engage price in terms of liquidity. Now, liquidity can also be found at psychological levels. Yes, there's what we call psychological levels. They are kind of round up numbers. Like, look at, maybe you have a trade around, let me see. I didn't want to talk about it before, but now let's say we have a trade around 15600, somewhere here. Now you see 15800, sorry. I'm trying to duplicate this. It's not working. Okay, so you see another price. This is another psychological level, 15800, just like that. You see another one in 1600. You see another one 16200, 16400, 16600. These are psychological levels where price will be interested in what retracing from. So those psychological levels act as support and resistance. So price tends to react from them. So price will want to sweep all of those zones in order to grab liquidities, because he knows that traders will have their stop losses in those areas. Not just their stop losses, you will see them, they have their buys, their buy stop limit, their sell stop limit. All of these things will be found in that in those zones. So we would want to look into sorry. Okay, so we would want to look into another aspect so you can well be aware. We call that liquidity grab or stop hunt. Liquidity grab or stop hunt. The knowledge of this will help you to know that the market makers want to hunt your stop loss. That's why we call it stop hunt. They want to hunt your stop loss. Now, let's see a market is in an uptrend, moving this way, going up, and then breaks high. Now, some buyers will want to buy from this point, right? They would want to buy from this point. Say, okay, after a break of structure, come back to, after a break of structure here, just come back to your demand or your fair value gap or order block, come back to it and buy. Now they are buying from this point and they have their stop loss above. They have their target here and their stop loss at this point. Now they want to engage in this buy. If you have the understanding of liquidity, you will check this move, this leg, and see if you have other zones around here. Then sure well know that price would want to take this zone as liquidity. Want to use this zone as what? As liquidity in price. If you do not see the liquidity, don't take the trade. If you cannot find liquidity, ICT will say if you cannot see the liquidity, you become the liquidity. Yes, if you cannot trace this liquidity, you become the liquidity because your stop loss will be taken. So you are the liquidity that is fueling the move in the market. Now, you will see this guy as an inducement zone that wants to induce you into taking this buy. Don't take it, leave it, and look for a zone below it, and what? Take your buys from here. So you take your buys from here. This is the safe zone. So for you not to be trapped, wait for your shift in market structure on the lower time frame for you to engage this price, or you come to this zone and what? Also wait for that shift. It's more like a confirmation entry in price, so that you can be safe. You can be safe. So this is it. You wait for it. The same thing happens if you are in a sell market. If you are in a sell market and then you want to start engaging this selling from here, no, wait for price to get to this zone before what? Before you start selling. Okay, so I think that would be the much we will be saying about this. Let's go straight into the chart so we can see real examples. I can find real examples so for you to understand better. So, okay, this was the trade I took today. This was the trade I took today. But let's just go to the 4-hour time frame. Or let's start from the weekly. Now, this is the weekly time frame. You see this high here. Oh. You see this high here. This high here, I told you equal highs. You have liquidity on your equal highs and equal lows. You have your liquidity in your highs and your lows and all of that. Now this is a high, okay? This is liquidity here. Price needs to come to take it. You see this high we are having here too. See this high we are having here. Is a liquidity. We call it buy side liquidity. Buy side liquidity. Why this low you are seeing here? This low here is a liquidity. We call it sell side liquidity. Sell side liquidity is also a liquidity. So at all of these points, you have liquidity. At all of these lows, we have liquidity packed in there. So this was okay. This is last week Monday's candlestick. This is today's candlestick. So I looked at it. Okay, where am I looking at price? Price, I've already taken this high. I'm not doing top-down analysis, so I'm just trying to show you liquidity. So let's go to the 1-day time frame. You see this is a high. If you check the market structure, market was coming all the way this way, formed a low, took out this high because this is a liquidity, took it out, came here, came back to this point. Look at this low, it came back and moved up. And what did it do? It took out this low. Now, this low is the liquidity that was taken. This low. This is a day candlestick. It took the liquidity before it pushed up to take out these highs. It's just like that illustration I gave recently. Now, some other persons in the lower time frame will be buying from here. They will be buying from here. They will be buying from somewhere here. Now, what did price do? Price took them out, tapping into this fair value gap here, and pushed price to the upside. So, someone that has the knowledge of liquidity will not be buying from here. He knows that there is a fair value gap here. He knows that there is also a demand zone here. And you see, that demand zone came to be tested. Even this point became a liquidity. This point became a liquidity. Look at it. Became a liquidity in price. See it? So price tapped into that order block in how many days from? Maybe like about 5 or 7 to 10 days later. It came into that zone. You get it? So you need to understand the issue of what? Of liquidity. Look at here now. We had a break of structure here. A break of structure. Now market went up, came back down into this fair value gap. This is a fair value gap here. Came into this fair value gap. And what? There was a reaction. Price came into this fair value gap. And within this day, it moved up. It would have done all of this move to the upside. And then came back down to clear it because it will use it as liquidity. Clear it to tap into this what? This demand zone. Tapped into the demand zone, but it has cleared this low as liquidity and pushed price up. Now, we have another break of structure and price has moved to tap into this demand zone. This doji candlestick is the demand zone that price respected today. So, I haven't seen that price is respecting this zone. I went down to the 4 hour to see to check out what I can see in that 4 hour time frame. I refined my order block. Let me refine it. No, this is not it. So I refined this order block. This is this last candle before the impulsive move. Now, this is what I have on the 4 hour. I went down to my 1 hour to see what I can see there. And what did I see? I saw this reaction from this point. Price reacted, showing me that price want to buy. And what now happened? It swept the liquidity. This is the sweep of liquidity I'm talking about. Because if I had seen this thing here, and then I decided to start buying from this candlestick, this doji candlestick, I started to buy from this doji candlestick, targeting this zone. I would have been taken out, my stop loss a little bit below. I would have been taken out by that week. You get it? I would have been taken out by this week. But then I waited and I saw a sweep of liquidity. Went down to 15 minutes. When I saw this sweep of liquidity, look at the candle that swept liquidity. Look at the candle that swept this liquidity. So this, my X, means a sweep of liquidity. When I see it, I saw this sweep of liquidity. Price came back into that candlestick. That candle that swept the liquidity came into it. Now, what did I see? I saw price now moved up, came back down, did not break this low, and cleared this high. That was my change of character. That was the change of character I needed to see. You can decide to also take it from this candlestick if that's what you want. But I wanted to be risk-free. Okay? I wanted to be risk-free. So I wanted more confirmation and I got it. Now, I went down to my 5 minutes to also see what the market is telling me. I saw that the market came to this point. I saw another sweep of this low. There was a sweep of this low and price pushed all the way up. After sweeping this low, it pushed all the way and took out this high that created this new low. Took it out. That was a change of character for me. The moment I saw that change of character, I was looking for an area that price would want to return back to. This is a demand here. This is a demand here. Okay? And this is another demand here. And that was where I saw that this demand was already mitigated by price. It was already mitigated by other candlestick and price moved. I saw this and I took my entry. Now I put my stop loss below this low in case price wants to come back down to mitigate this zone. That was why my stop loss was here. That's why I did not put my stop loss here. I had to put it below here because I was certain price was going to move in that direction. Now you see how I used the knowledge of sweep of liquidity to engage price here. Now I also used the knowledge of trend line liquidity to find where to take my profit. I took my profit around somewhere here because all this move was tiring, so I had to take out. But this was my full TP. I was waiting for price to take this equal highs. See this equal highs? This is where I'm expecting price to take. You see it? Liquidity. This is relatively equal with these highs, and liquidity are packed up here because support and resistance trader will be selling from here and they'll put their stop loss up here. So the market makers will want to take out these highs, these equal highs, and that is where liquidity are found. Now I saw trend line liquidity. See it? You see all of this move. This is trend line liquidity. This trend line liquidity. I knew price was going to take that out. Trend line liquidity. I knew price was going to take out all of this zone. That was why I held this trade. I held it up to this point where I became tired and I needed to go out. Okay? But now you can still get another entry from here using this knowledge of liquidity I've just talked about. Now let's see. We add this break of structure. We had this break of structure, and where will you be looking at as your demand? This doji candlestick is your demand, and price did not come into it. Look at it. Price went all the way up, did not come into it, came to this point, came down to this low, created this low, and after creating this low, what did it do? It took out this high. You see it? Even though this is more like a sweep of liquidity, because it did not close with a full body candle. So, but if you go down to lower time frames like 3 minutes and 1 minute, you see it as a break of structure because it will close with a body candle. Now, someone can decide to say, okay, let me buy from here. Let me buy from here. And of course, this is a fair value gap. What did price do? Price reacted from this fair value gap and bought all the way up. So somebody will be saying, yes, so this is my liquidity. That's if you do not, yeah, this is my liquidity. Let me just buy from here. Let me just buy from here. And look at it. Price, even though he reacted from here, but what? He cleared them out and came to react from this demand zone. So the knowledge of liquidity, you would be waiting for liquidity to be swept. This is liquidity that needs to be taken out. This is your liquidity that needs to be taken out. You see it? So if you allow this liquidity to be cleared, and price tapped into this zone, let me tell you, look at confirmation, candlestick confirmation, rejection, price moved up higher and came back again to give you another entry. See, another entry. This is another demand zone. If you go to your 3 minutes time frame, you will see many opportunity that price gave for an entry. You see it? Price moved this way, came down, came to this point, came back down and cleared it. That is the change of character, and then retraced into this other block. So this is your change of character here. This black candlestick becomes your what? Your demand zone to engage price. And that was where price bought all the way from. You see that? So you would have also been in profits now, engaging from here. This is a 4 risk to reward trade. You would have even taken your profit at this high because you know liquidity is packed on highs and lows. So you would have taken your profit here, which will be about 3.6 risk to reward. So that is that about liquidity. So that is the much I will be showing about liquidity. If you have any question, please you can ask me in the comment section. I'll do well to address those questions in the comment section. And if you have any aspect in Forex you would want me to talk about, I would do justice to that. Just type it on the comment section. I would look into it and make the next video for you guys. Yeah, if you have yet to subscribe to this YouTube channel, please do well to click on the subscribe button and also turn on the notification bell so you can be notified when I drop other content. Every week I will drop a content that would, top up your knowledge in the Forex market. Thank you very much. Enjoy the rest of your week.